The U.S. government released another hot inflation report, and the Federal Reserve is finally paying attention to what we've been saying for more than a year on this channel. You can't print all this money without consequences. In today's video, we'll cover what was in the latest CPI report, what we really need to pay attention to, and what you can do about it. Let's get into it. This week, the Bureau of Labor Statistics released their monthly report on the Consumer Price Index, which showed prices rising 7% in December 2021 compared to the same time the year prior. This is the highest rate of inflation we've seen since June of 1982. According to the report, the biggest drivers of the year-over-year increases came from used cars and trucks, which have surged 37% over the last years, as a global semiconductor shortage has limited production of new vehicles, pushing consumers to the used car market, resulting in much higher demand than this market usually sees. The government report stated that housing costs were also a major contributor to inflation, although this doesn't come as much surprise given that home prices have skyrocketed around the country over the last 2 years and rental rates are following suit. The shelter component of the CPI increased 4.2% from December 2020 to December 2021. This is the highest year-over-year increase in the shelter CPI since February 2007 at the peak of the last housing bubble. And in the available data going back to 1997, there has never been a year-over-year increase greater than 4.3% in this component of CPI. And while not as strong of a contributor as in previous months, food prices did maintain an upward trend, with the price index for food at home increasing by 6.5% year over year, and the index for food away from home increasing by 6%. So those are the biggest contributors in this most recent inflation report from the government, and at this point you may be asking, so what? What does this matter to me? Well, behind the numbers are developments taking place that could very well shape the course of 2022. Inflation is now bad enough that the Federal Reserve can no longer hope that it goes away just by telling everyone it's going to go away. They've made it clear they'll be reining in their easy money policies, and it's happening faster than many had thought just a few months ago. They'll be raising interest rates, halting the money printing, and reducing their balance sheet. This has the potential to sap demand in the housing market from rising interest rates, pushing mortgage rates higher. It might make Wall Street actually work for a living instead of being on the receiving end of cheap money. And it could put significant downward pressure on the bond market as the Fed begins to unwind their substantial bond holdings. The rising shelter costs are something to be concerned with as well. When rents and home prices go up, they don't usually come back down outside of a major market correction. This then puts upward pressure on wages, as the higher cost of living is not something employers can ignore, especially in the tight labor market we have now, where the record number of job openings is far greater than the available supply of labor to fill them. We're seeing this impact on wages now as well. The latest data on wages shows average hourly earnings have increased by 4.7% year over year. Rising housing costs and wages tend to lead to even higher rates of inflation, and it is exactly what the Fed does not want to see right now. And finally, the CPI's increase in food prices may not seem like much right now, but there are some other food-related costs that are showing a worrying trend, most notably fertilizer prices. The Producer Price Index, which released the day after the Consumer Price Index report this week, showed that fertilizer material prices have gone up nearly 100% over the last 12 months. This has come in the wake of a global fertilizer shortage that shows no sign of ending at the moment. This will force farmers to make some tough choices this spring and decide if they will even be able to turn a profit if they plant their crops. Couple that with an ongoing drought, and we could see surging food prices and possible food shortages if this trend goes the wrong way. We're going to be covering each of these important topics in more depth in our upcoming videos this week, so make sure you're subscribed and hit that notification bell down below so you know right away when those are released. And at this point you may be left wondering, this is great, Mr. Papaya. Thanks for giving me some really uplifting news. What can I do about it? Well, one way to think about inflation is not so much that prices are rising, but your purchasing power is falling. Your dollar just doesn't buy you as much as it used to. So protecting your purchasing power is one way to deal with high inflation. We've started a series on this channel called Investing During High Inflation, where we're looking at different assets and commodities you can invest in to help protect your purchasing power. So far, we've looked at precious metals like gold and silver and cryptocurrency, especially Bitcoin, and how they could play a role in your portfolio to protect your purchasing power. I'll leave a link to that playlist in the description down below. We'll be doing more videos on this topic covering real estate, stocks, and many other things to consider during times of high inflation like we find ourselves in now. Make sure you're subscribed. Hit that notification bell so you won't miss our next video in that series either. I hope this video has been helpful for you. If so, please give it a thumbs up to support the channel and help us grow. Thanks for stopping by, and I'll see you in the next video.